All right, so I wanted to shoot this video because there's a bunch of bad information out there right now, and panic and fear and anxiety are ruling the day. So much so that I'm getting phone calls from clients going, hey, should I be selling? Are we about to have another foreclosure crisis? What's going on? I've seen so much fear-based. So I wanted to just kind of back up and set the record straight. Let's take a look at everything from a historical standpoint and where we are now. This is not 2008 all over again just because of COVID-19. All right, I'm going to share my screen.
I'm a man on a mission.
My mission is to help people break through all the noise out there and
Don't need no permission.
I want to help you get to actual truth. Don't you just want the truth? All right, so I did this whole thing. I want to answer a couple of questions that are just out there right now, and there's some bad information out there right now. The first one I want to talk about on this video is actually interest rates. How is what's happening in this global pandemic affecting, impacting interest rates? All right, let's see. Let's take a look. I'm just going to give you a little bit of data here. If you look at over the last 50 years, the 30-year mortgage has always moved in unison with the 10-year treasury. Now, when equities or the stock market, as it's, crashed, I know we had a couple up days or, but it's an up day, down day, whatever. It's down quite a bit since this outbreak started. As that has gone down, people move out of equities and more into treasury bonds because it's safety. It's considered widely across the globe one of the safest investments you can make. The 10-year treasury note, right? So U.S. treasuries. The 30-year mortgage rate has historically always moved in unison. Let me show you this. Again, 50 years. This is the green line here is the 10-year treasury. The blue line is your 30-year mortgage rate. What has happened since it's been tracked? I mean, I listened to some people. There's a guy I listened to that's considered the oracle of real estate. Okay? He said since it's been tracked, it has never not moved in unison until last week. So we are in somewhat of a new territory. And it's all because of the uncertainty. It's also because your basic supply and demand. We are talking about an economic thing here. So your basic supply and demand. Let me show you this. This is from the First American. It's the deputy chief economist. I'm just going to read part of his statement. It said, as evidenced by recent events, often the spread increases because mortgage refinance application processing capacity cannot be met. So lender offered rates don't follow the treasury yield down one for one, meaning for the first time in history, if you look back here, the green line, the treasury dropped, rates rose a little. And it was all because of the demand of refinances. I can't tell you how many people last week called me up going, hey, how do I get one of those 0% mortgages? First of all, mortgages are based off of other things, not the Fed fund rate. The Fed fund rate was dropped down to zero. You don't get one of those 0% mortgages. They don't exist. That's called free money. Okay? So I'm going to go back to the statement. So while mortgage rates have declined in response to the decline in yield, it is unlikely to fall by the same magnitude as the treasury yield. It is plausible that mortgage rates will fall further if the 10-year bond declines even further. And it's also reasonable to think that it's going to drop a little once all this goes away. All right, the 10-year treasury will probably come up and the two will match again and start to go in unison. So we are in a little bit of uncertainty. But let's step back for a minute. All right, let's step back for a minute. Look at this. This is the 30-year fixed mortgage rate since June of 2018. We were 4.5 then, and yeah, we dropped to 3.29 and now we're at 3.65. But let's take a look back. Just step back a second. I owned a mortgage company. Most of you know that. I owned a mortgage company for years. And in 2005, I was refinancing people into 6%, and they were very happy to get out of their 8 and 9% mortgage. All right, I was refinancing that all day. So if you look historically, we are still really, really low. I had a friend of mine call me. I graduated high school with him, so we've been friends for a while. Called me up the other day and said, hey, listen, I'm buying a place in Warner Robins where I'm getting stationed. Okay? I was at 3 1/8, but my broker just called and said, hey, I can go to 3 5/8. Look at this exact chart. It's exactly what happened. And I can lock it in for 90 days because it's a construction loan. Just want to make sure that, that's going up. That going up almost a half is true. So not that his broker was telling me anything different. He just was calling a friend who he knew was in the business. So I talked to him about this exact stuff, and it was like, okay, that makes sense then. All right. It's still historically low. If your first number in your interest rate is under 5, you're fine. I mean, if it's in the 5s right now and you want to get in the 3s, okay, maybe it is a good time to talk about refinancing. I don't know that the interest rates are going to drop. There's a little bit of uncertainty there, but we're in the 3s, guys. We're still really, really, really low. So that fear needs to kind of go away. That, hey, interest rates are going to skyrocket or interest rates are going to fall. No. Banks have to keep an interest rate at a certain level in order to maintain profitability. And I get it. We're taking advantage of it because at 3.5% or 3.65, that's almost free money, especially on a 30-year mortgage. I've seen somebody right now getting a 15-year mortgage in the 2s, 2 1/8 or 2 1/4. That's ridiculous. And sometimes that particular person was refinancing, and this is why rates aren't falling. Remember what he just said? It's because they're overloading the refinance market. But, it makes sense. That particular client is refinancing her 30-year mortgage that she's 3 years into a 15-year mortgage, and her payment is staying the same. So she's shaving 12 years off her mortgage. I get it. It makes sense. That's why we're not seeing mortgages, because they're offering so much now. It's so good, they don't have to drop anymore. There's a huge demand for it right now. So that's why we're in that level of uncertainty, and that's why things are just going to maintain level, especially during this COVID-19 thing. All right, let's take a look at the next question. Let's look at what happened with the stock market. What has happened with the stock market and how has it impacted real estate in the past? Well, and this is one of the big things that I wanted to make sure of. During the mortgage crash, which everybody thinks we're starting now, we are not. This is not a housing event. COVID-19, coronavirus, whatever you want to call it, is not a housing event, and I'm going to prove it right now. When we looked at the housing and mortgage crash, okay, the S&P from 2007 to 2009, the S&P corrected itself down 51%. It lost half its value. Home depreciation, because that did happen, 2007, 8, and 9, dropped just shy of 20%. It's 19.7. Okay? So that was a housing event. But let's take a look at some other events. This is actually, David Rosenberg hit the nail on the head. What we are experiencing right now with coronavirus is more like the 9/11 event when it comes to housing. Take a look. What 9/11 has in common with what is happening today is that shock also generated fear, angst, and anxiety among the general public. People avoided crowds. Remember that after 9/11? Because they believed another terrorist attack was coming. They're acting the same way today, partly because we're told to. All right? But they're doing it to avoid getting sick. Same parts of the economy are under pressure. Airlines. I've seen pictures of airlines and airports, just nothing. Ghost towns. Leisure, hospitality, restaurants, entertainment, consumer discretionary. These are all being attacked again because it is an isolated event. So we are acting just like we did at 9/11. It's just the same thing. Let's look at what housing did during that time. The S&P corrected itself during 9/11 from September 2000 to October 2002. It went down 45%. At same time, houses went up in 2000, 8.6%, 2001, 6.6%, 2002, 8.5%. So if we follow our history and this acting just like we did, think about it, we are acting just like we did after 9/11. Well, this is probably what's going to happen. I don't know that we're going to see that much appreciation, although we may, just because of supply and demand. My other show that I do, How's the Market, Pensacola, shows that supply has come down even further. I said we had a supply inventory crisis to begin with. We've got an even more one now. Okay? But this is our appreciation, what happened there during that particular time. All right? Are we in a recession? Yes. Yes, I firmly believe that. I firmly believe we are in a recession. But what does a recession mean? And what does it mean for housing? A recession is just 2 consecutive quarters of reduced GDP. Are we going to see that? Yes. Yeah. Goldman Sachs just came out with something. Well, Bill McBride said, look, with the sudden economic stop and with many states shutting down by closing schools, bars, restaurants, my view is that the U.S. economy is now in a recession that started March 2020. GDP is going to decline sharply in Q2. The length of the recession is going to depend on the pandemic. How we get out of that pandemic, that isolated event, okay? I know it's a global event, but it's isolated to one thing. Here's what Goldman Sachs forecast. All right, we're going to be down in the first quarter. We're going to be down a lot in the second quarter just because of the shutdowns. It's going to take a minute to get back to profitability. All right, we're going to feel that. Companies are going to feel that. The country's going to feel that. So there's your 2 consecutive quarters. Then in quarter 3, we're going to be up. Quarter 4 will be up, and we'll definitely have much stronger gains next year once we get past this event. I keep saying event because I want it to be really digged in that, look, this is an event. I understand the anxiety that has blanketed the globe. I get it. But it is an event, no different than 9/11. It's more global, but we're acting the same way. So how does that work for housing? We do not expect, this is Wells Fargo, we do not expect a repeat, a severe recession of 8 and 9 because the virus and oil shots are not endemic to the financial system, but are rather external. Once the virus infection rate peaks, we expect a recovery to gain momentum into the final quarter of the year. They think it's going to be Q4 before we go back to possibility. Not possibility. Let me try that again. They think it's Q4 that we get back to profitability. But they also say in 2021 we're going to get back to profitability. I have used this slide right here multiple times over the past year, 2 years. One of my most downloaded podcasts in 2018 was when I said recession 2020. Did I know anything about coronavirus? No, not a clue. But we were just kind of pointing to it. But if you look at the last 5 recessions, here's what housing has done. 3 of them, housing went up. 1 of them, housing went down 1.9%. And in 2008, which is the most recent one, that's why everybody's concerned, is because they're remembering the most recent one. So it's a knee-jerk reaction. It's okay. It's all right. But in 2008, it went down 19.7. That's why I'm getting the questions. Hey, are we going to have foreclosures? I literally had a client call me saying, hey, my house I think is worth about $200,000. Somebody just called me and offered me $140 and said I should take it before the foreclosure crisis starts. Should I? They own their house free and clear. I went, don't you dare. Don't you dare take that. Okay? Because people are using this pandemic as a tool to scam people out of equity. Don't do it. Don't do it. All right? So let's talk about, are we going to see a rise in the number of foreclosures? Are we going to see that? I know hedge funds were calling banks. Hey, do we need to be putting some money aside? Some of this capital that I've got in the 10-year treasury yield right now that's not making much because the yield continues to drop. Do I need to be putting that aside to be able to buy properties? Let's talk about it. FHA, the Federal Housing Administration, indicated it's enacting an immediate foreclosure and eviction moratorium for single-family homeowners, meaning they're not going to work on a foreclosure and they're not going to evict for the next 60 days. Now, why is that important? They did not do this in 2008. They did not do this in 2008. But let's look. This, I wanted to kind of make real good sense here. It is not the same marketplace. If we look between 2005 and 2007, the country pulled out $824 billion out of houses, out of an appreciating asset to buy stupid stuff. We bought jet skis. We bought boats. We bought lavish vacations. That's what we did. We bought stupid stuff. Now, if you look between 2017 and 2019, we pulled out $232 billion. So what is that, 25%? We've learned our lesson. I also wrote down some other statistics that was given to me. I didn't have a chance to put it in the slide, but look, 37% of housing right now across the country have no mortgage. None. And out of the other 63% that have a mortgage, 25% of those owe less than 50%. Now, you sit there and do the math if you want to. That's fine. But what I know, what's already been worked out, that means that half of the U.S. housing owes less than 50%. So they owe less than 50% of their house's worth. What does that mean, Shane? How does that affect us? That means even if I'm wrong and we have a little bit of a housing dip, we have a little bit of depreciation. I'm wrong. And we have a depreciation. The housing market can handle it. We couldn't handle it when we were looking in 2008. We had took out too much. We had over leveraged. We can handle it now. If it happened, I don't think it is. We're still supply and demand. Mortgages are still a little more difficult. They're not just giving mortgages away to anybody. We're not doing mortgages at 125% loan to value, meaning that, the property was worth $100,000 and we lend you $125,000. That was happening in 2006, 2007. I saw it all the time. So we were over leveraged at that point. We're not now. We, as the country, have learned our lesson there. At least the generation that went through that has. Will history repeat itself? Who knows? I can't speak for the next generation. All right, we can try and teach them. That's part of our job. All right, here's another reason why I think that housing could handle it. Look at a payment as percentage of income, meaning what is your housing payment as a percentage of your income? The historical norm is 21.2%. We're at 14.8. Now, what does that mean? That means if it's a two-income household, then if one person got laid off, we more than likely could handle things. Now, I know some of the banks are starting to talk about skipping payments, working deals. I get it. We're going to have to. All right. Well, we've already learned that. We went through an area where payment modifications were becoming the norm. That was 2011, 2012, when I was helping people with a lot of short sales and avoiding foreclosure. Okay. That has happened. So the banks are kind of used to this. It's not something new, and we don't have to have a 2 or 3 year ramp up. They know how to do this and keep it profitability, especially with some of the money that's coming out of Washington. So our historical norm is down to 14.8 from 21.2, which is what it is normally. We're at 14.8 right now. So again, I think the housing market could handle it if it was just slightly under. We've kind of learned our lesson. There are some people that are still over leveraged. I know some people watching this going, man, that would be great if I was at 14.8 or if I only owed 50%, but I owe 98%. So if it goes down to, I might be underwater. Okay. I get it. I understand. I do. I don't owe 50%. I owe much more than 50% of my home. But I don't think we're going to see that. We've got basic supply and demand, especially around our area here. I have got huge demand numbers, even with COVID-19. I've got a buyer trying to buy a house. We have put an offer on 4 properties and good offers. What they're asking are slightly over, right? 4 offers. The property in 2 days, all 4 properties in 2 days were under contract and we lost. So I don't think you're going to have a supply and demand problem. There's nothing that indicates we're going to have a downturn at all. This is just an isolated event. And if we go back to that slide right there, if we look just like the .com or the 9/11 crash of the S&P, prices appreciated. Prices are going to continue to appreciate. That's what everything's pointing to. So here's what happens right now. I get asked this question. So how is our market here, Shane? What's going on? And I just kind of wrote out my answer because this is kind of what I say every time. I'm like, look, it's day by day. It's hour by hour. All right, some of the buyers are telling me to hold off for now. I'm backing them up with that. No problem. I'll support that decision. I just want to give you information because some of the misinformation out there is kind of pissing me off. I'm going to continue to communicate with them, keep them aware of what's happening in the market. Some of my clients actually need to sell or buy right now. So what does that change? How does coronavirus change that? We're doing that with protocols of safety first. Safety first. I'm doing a lot of smart marketing. I'm doing a lot of virtual showings. Virtual showings is something that is becoming more and more popular. Now, I've done that for 10 years because I work in a military town. I can't tell you how many people have bought property with me that are still stationed in Italy or still stationed in Hawaii or still stationed in Guam, and they're coming here. All right. Some of them even stationed in San Diego, the Pacific Fleet, and they can't get over here to walk the property. I remember a couple that was moving here from Hawaii. And this was, 6 years ago, I think. And I just went over to the property. I said, okay, we like this property. We've got the pictures from it. But she goes, I just want the feel. I went, okay, no problem. We did a private Facebook group, just the 3 of us. And I went live. And I literally had my phone. And I was like, she goes, okay, turn right. Okay. Okay. And I walked through the property like a drone. So this is not something that's out of the norm. They bought the property. The first time they saw the property was the final walkthrough before they closed. And that story was kind of funny because we pulled up, the final walkthrough was at 10 o'clock in the morning. When I pulled up, I went, hey guys, because the first time we're actually meeting face to face. Obviously we had done the protocols like this, the virtual showings, the Zooms, right? So I'm like, hey guys, welcome to Florida. And both of them looked at me and went, shh, shh. They're both Navy. I went, well, what's wrong? They said, we found a place last night called McGuire's Irish Pub. And they have something called, I went, oh, an Irish Wake. Yeah, we probably had too many of those. It's funny. I make sense. All right. And I'm trying to make a little bit of light. We walked through the property. They loved the property. Lived there for 4 years before it was time for move on to their next duty station. And so we sold it at that point. But those virtual showings, that virtual marketplace is going to continue to grow. And it's something I've been doing for a long time anyways. I've sold properties on YouTube, Facebook, Zoom. It's something that has happened. We're just ramping it up now. And with an inventory problem, that's not, it's just keeping things moving. All right. So look, here's my thought. Coronavirus is here right now, but this is going to pass. And we as a society are going to get through this together if we do what we're supposed to do. I've seen a bunch of people still out trying to congregate. Stop it. Stop it. Let's move the virtual right now. But I do not want the bad information about my marketplace, the real estate marketplace, being posted out there. So that's why I did this video, so that you understand the data. I'm giving you the data, I'm giving you the information, and I'm trusting that you'll use it properly. Do me a favor, share this video. Get this information out there so that we can calm down some of the fear mongering that's happening. I do not want a phone call from one of my clients saying I sold my $200,000 house for $140,000 because the foreclosure market's coming. I do not want that for my people. If I can do that, even if you're not one of the folks that work with me, do not do that. Find your trusted professional and talk to them. Talk to them. Okay? I really appreciate you guys watching it. Like I said, do me a favor. Share this. Share this video to get this information out there. Have a good day.
I'm a man on a mission.
My mission is to help people break through all the noise out there and
Don't need no permission.
I want to help you get to actual truth.
On a mission.
Don't you just want the truth?